What's up guys, Ben here and welcome to Motivation to Invest. Today I've got a really special video for you guys. This video is being heavily requested by the community and it's going to be on my entire investing strategy. Now this video is part of a series for my VIP membership group in which I'm going to be covering my investing principles, my investment strategy and finally my entire six-figure portfolio, the stocks and the story of how I built it up to where it is today. But if you're new around here, then why not join the community by hitting that subscribe button and turning that notification bell on. Also, to help us wake up the YouTube AI, feel free to give this video a big thumbs up. That helps out tremendously with the channel. And if you're interested in the VIP membership, feel free to check it out. All details are in a link in the description below. With that being said, let's not waste any more time and let's dive in. What's the motivation behind this? Why are we doing all this investing? Well, there's a great quote by Warren Buffett and it says, if you don't find a way to make money while you sleep, you'll work until you die. To me, that's a great motivation to invest. It empowers you each and every day. So investing is just a tool to help you guys reach your financial goals, whatever they may be. I personally love the entire process as well. So my investing strategy has been derived from my investing principles, which I covered in a previous video. So please do check out that video. It's an extremely powerful video. But generally the process combines all the great billionaire investors of which I've studied over many years. I've read over 250 investing books. I've made over 250 investing videos on this channel, all to learn the art of investing. And I've distilled all that wisdom into my investing principles, which then becomes my investing strategy, of which I'm going to reveal to you guys in this video. Now, some of the principles include, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Basically, that means you should look for these exceptional companies with exceptional management, exceptional prospects, and they're great companies to invest into, rather than just trying to look for the downtrodden companies which may be better value but may not be better compounders in the long term. Also, with my strategy, I'm a firm believer that volatility equals opportunity. So volatility is not risk. Volatility is these ups and downs in the market, the crazy things that happen in the stock market, and our job as investors is to take advantage of those volatile swings. But generally my investing strategy is to analyze companies using two main categories. That is quantitative analysis and qualitative analysis. So quantitative, that's the numbers, that's the income statement, that's the cash flow statement, that's the balance sheet, that's all the financial metrics that we need to look at for the business. But this is not just a numbers game, and that's why we don't see all accountants and mathematicians as multi-billionaires, because investing is not just a numbers game. There's also the qualitative analysis. So that's the brand, that's the competitive advantage of the company, that's the exceptional management team. That's that feeling you get when you use that company's product or service. For example, there's a great quote by Peter Lynch, who's in this book right here, and that is, chances are if you like the product, you may like the stock. So maybe you're using a certain product and you think, wow, this is incredible. Or you see friends using it, or you see the shops busy, full to top of people, and a certain product is selling out, then chances are that that company could be a great company to invest into. So that could be a seed for you to start doing some more research. The qualitative side can also help you look for an information edge in the market. Wall Street will obviously factor in the majority of information out there, and that will be baked in to the stock prices. However, what information can we derive from Main Street which Wall Street doesn't know about? And that is where you can find great investing opportunities. For example, a legendary investor named Philip Fisher popularized this method and called it the scuttlebutt method. He used to interview CEOs, he'd interview ex-employees.
What do you think are your greatest strengths as a manager? I work too hard, I care too much, and sometimes I can be too invested in my job.
He'd interview customers, he'd look around the company, he'd ask people about the company's products, and through that information, of which Wall Street can't really quantify, he'd find some exceptional investing opportunities. So I've put my own spin on that and combined it with all these other legendary investors' great investing principles to come up with my own investing strategy, of which I found to be incredibly successful. So let's dive now a little deeper into this strategy. These are the factors I look for when selecting any investment for my portfolio. So we're looking for compounded annual growth rate on the revenue of at least 15 to 20% for a growth stock. growing and increasing earnings per share. Businesses with high and consistent return on invested capital. Charlie Munger says 18% plus is fantastic. Consistent and high gross margin, so greater than 40% is incredible. This is why I do like software companies, because they have high margins. You also have companies which have a competitive advantage, tend to have higher net margins. 20% is very good. For example, Apple has higher margins than Samsung because Apple has a stronger brand and more of a competitive advantage. Thus, Apple's stronger brand can give them higher pricing power and give them better margins. If you are investing into a growth company, look for those with a clear path to profitability. Not just, oh, we're going to be profitable sometime. What year are you guys going to be profitable? Is it 1 year, 2 year, 3 years, 4 years? What's the plan? And does it make sense? This is a great quote by Fisher. Prefer future growth over dividends. So I see a lot of people obsessed with dividends. Usually if a company's paying lots of dividends, it means the growth opportunities aren't that great. I do think dividends make more sense as you get older. So look at your own investing goals. If you're getting close to retirement and you want to live off the income more, then dividends can be an option. You can start pushing your portfolio slightly more over to more dividend stocks. I recommend REITs, real estate investment trusts. You can usually get 6 to 7% dividend, which is fantastic. Quantitative factors 2. The value of a business is the present value of all expected future cash flows. What's the present value of the company's expected future cash flows? To calculate that, there's a calculation, discount and cash flow calculations I've done on the channel before. Industry growth, which is largely a driver of long-term revenue growth. Now that's from a study by McKinsey on valuation. So that's a consulting company, very reputable company. Low price to earnings ratio, low price to sales ratio, all reasonable for the industry versus their competitors. That's how you value the company. Price to book value less than 1. Obviously, this is if you're doing deep value investing. If the company's got a price to book value less than 1, that means the stock price is less than the amount of cash or assets that the company actually has. If the company liquidated or went bankrupt, you'd actually still make money, and that's an incredible feat to see. This is what Benjamin Graham used to do, the father of value investing. PEG ratio less than 1. PEG ratio is your price to earnings growth ratio. Peter Lynch looks for less than 1. GARP ratio, growth at a reasonable price. So really that's what we're after. We're after growth at a reasonable price, and that is the dream. Quantitative factors number 3, cash flow statement. Observe the capital expenditure. What are they spending their money on? So if they spent on properties, plants, equipment, ideally the percent of capital expenditure relative to net earnings should be as low as possible, so less than 25%. So how much is that company investing in order to gain net earnings? Does the company have to build lots and lots of new factories and have to keep purchasing new equipment? If so, then that is not a great sign for shareholders, because it means that investment that you're putting in could be diluted in the future. Exceptions are long-term investments which will benefit the business over time. So an example of this could be Tesla. They're spending a lot of capital expenditure on building new factories, but they should benefit the company a lot in the long term, as the company will be vertically integrated, meaning they tend to make everything in-house. For example, looking at capital expenditure here, Apple has less than 25%, Samsung has 65.9%, so Apple is a much better company than Samsung in terms of that factor. Also, companies which invest more into research and development tend to provide better returns for shareholders. Google is an example of that, and Amazon. They both invest a lot into what they call diversified technology bets. For example, Google invests into autonomous vehicles and with its Waymo technology. Balance sheet, current ratio, I've mentioned this many times on the channel. So that is the current assets to the current liabilities. How much cash is the business got on hand to pay off their current debts? I don't factor in intangibles because I feel that they're just most of the time ridiculous. Most of them could be obtained from an acquisition. Many academics do agree with me in that sense. Long-term debt low, so I look for companies with low long-term debt or sufficient long-term debt. So if you want numbers on that, pay off long-term debt with less than 4 years of earnings. That's a great sign to see. Qualitative factors. Now, this is what the numbers people, what the accountants, mathematicians tend to struggle with. And more of the intuitive people, they tend to pick up this quite well. Certain people, they could have told you many years ago, Apple was a cool brand. They had something unique about them. So did Netflix. When you think of Uber, you think of taxis. When you think of Netflix, you think of streaming. When you think of Apple, when you think of quality products and beautiful design. Buffett actually calls this the share of mind principle, and that's how a psychological connection with a company's brand. So that's something to watch out for. So you're looking for a strong brand. Disney, Coca-Cola, all very strong brands. Companies with a competitive advantage or moat. What's stopping somebody else from just doing the exact same thing as them? Do they have a competitive advantage? Clear company mission. Now, this is something I really do like, and that is mission-driven companies. Tesla is an example. Our mission is to accelerate the world's transition to renewable energy. If a company has a mission, it doesn't just benefit the company and the shareholders and the management, it benefits the employees, because there's a whole culture with the company that we're not just about making money, we're about changing the world and really putting a dent in the universe. And I think that's so powerful. It inspires investors, it inspires the employees, it inspires the management. Everybody wants to get on side with this company because they're doing something great for the world. And that's why we've seen Tesla reach all-time highs. So look for companies which solve a real problem. Does the company solve a problem, or is it just trying to exist? For example, Elon Musk quoted, "You get paid in direct proportion to the difficulty of the problem you solve." So look for companies, are they solving a real problem? Is there a need for this product or service? Do you have an information edge? So I mentioned this earlier, ask your friends, ask your family, what's their experience using that product? What do they think of the product? Do they enjoy the product? What do they think of that product compared to their competitors? This can be an information edge which the people on Wall Street don't have, but you guys can have by just speaking to friends and family. Qualitative factors too, extraordinary management. So really, businesses are run by people. A business is just a collection of people moving towards a common goal. And exceptional people can perform exceptional things. Look at Elon Musk, the way he's took Tesla from a nearly bankrupt company to the world's largest automaker / technology company. Amazing things if you can spot the right people. So the goal of management is to manage the business and allocate capital to achieve high returns. That's it. That's really the goal of management. I believe also to inspire integrity and communication. So a great quote by Buffett, I look for 3 qualities when hiring or looking for a business partner: integrity, intelligence, and energy. If they don't have the first, the other 2 will kill you. So honesty in management. Do they just talk about the great things about the company, or do they also talk about the negatives? Skin in the game. Does the management have investments in the company? What % do they have invested into the company? Great CEOs, Jeff Bezos, Elon Musk, Mark Zuckerberg, they all have a large percentage of their own net worth invested into the companies. Even Warren Buffett in terms of Berkshire Hathaway. Right, so I've blasted through them. That's the quantitative and qualitative analysis. Now, that information I've just gone through, that is worth, I believe, millions and millions of dollars. Just because the wisdom that's been built up over that time is just so powerful. That distilled wisdom is from all the great investors over the past 100 years, and it's been distilled down into me just blasting through these slides. So that is great value for you guys. I hope you are enjoying this video so far. You should be taking in a lot of knowledge here. I can dive much deeper into many of these topics, but I'm trying to keep it short and give you guys an overview. So when to sell? I always get asked this, when to sell. Reason 1, when the company's fundamentals change. If you have an investing thesis, I invest into the company because of X, Y, Z, and that changes, then you should potentially think about selling. Reason 2, portfolio rebalancing. You might say, okay, I want to be 20% exposed to the electric vehicle sector. When the electric vehicles stop run up and you're now 50% exposed in your portfolio, so 50% of your wealth is exposed to electric vehicle stocks, then you could potentially sell some, take some profits in order to reduce it to that 20%. Many investors also have 5% gold in their portfolio. So last reason to sell, if you've found a better opportunity. So I call that opportunity cost. So let's say you're in an investment and it's a pretty dead investment. It's not really doing anything. And you find this great investment, this great investing opportunity, then you can potentially sell that investment and put it into that investment. Other times to sell, of course, if you're trading stocks and you're trying to do short-term plays, then you're going to be buying and selling regularly. From all that information from our Whitehall principles, I've developed my portfolio structure. So it's a very simple structure, 6 pillars here. I look for exceptional companies at a fair price, low risk, high reward bets that fit all the quantitative and qualitative analysis. So they fit all the numbers side, which I mentioned in this presentation, and all the qualitative side, the culture, the brand, the management, etc. I structure the portfolio to be diversified across multiple businesses, across multiple industries, and globally. And my position size is relative to criteria. So let's say I have 10 boxes to tick and it only ticks 4 boxes, but I still think it's an okay investment. Then I'll maybe open a small stake. If it ticks all 10 boxes, exceptional company, fair price, great management, all the quantitative factors, all the qualitative factors, if it ticks all those boxes, then that is when you load up the truck and I'd really go heavy into that stock. But very rarely that does happen, but it can happen, especially during market crashes. I also tend to have a long-term horizon on the majority of my investments. But what I must state with constructing your own portfolio is you must know it's a dynamic process. You can have all these rules in place, but if the opportunities don't come, the opportunities don't come. So really, you need to be prepared for the opportunities and make the best of those situations when they arrive. To find entry points, I believe volatility equals opportunity. I buy the dip, I buy on bad news if the fundamentals of the company haven't changed. So if they've had maybe a small earnings miss, but the fundamentals are still strong and I know the reasons for that earnings miss, then that is when I may buy the stock. Am I going to be a contrarian right in this situation? Dollar cost averaging a portion of your monthly salary each and every month into stocks. And then use technical charts. So you can also use technical charts to find, so say a stock's crashing down, rather than trying to catch a falling knife, you can wait for it to hit to support and then invest into it. So that's the portfolio structure. So that is this video, guys. I hope you found this enjoyable. There's a lot to take in there, a lot of information. If you did find this valuable, please do comment those thoughts in the description below. And for my VIP members, I will be doing a portfolio reveal on the next video, so you guys can stay tuned for that. For the rest of you guys, if you haven't checked out the VIP community yet, feel free. There's a link in the description. Check it out and see if it fits your investing style. Access to my buy and sell signals, portfolio reveal, and our private Discord chat where we have like-minded people all together with the same investing goals. So feel free to check that out. And if you guys found some value in this video, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you're new around here and you still haven't subscribed yet, what are you waiting for, guys? Go ahead and hit that subscribe button and turn on that notification bell. With that being said, I hope you guys have a fantastic day, and I'll see you in my next video. Invest safe.